Hi guys, in today's video I have award-winning mortgage and protection broker Glen Russell joining me on the channel. He has indeed been on the channel before. I'll put a link to the first interview in the top corner of this one. Just to let you know, I will be adding timestamps below to this video. This means that you can go to the exact questions that you wish to go and view and see what his answers were. Glen has a wealth of knowledge about mortgages and protection, so I think you'll find today's interview really useful. I know I certainly did. Finally, just before I hit play on the interview, I must just say, Glen has very kindly offered that if you have any questions, just leave them in the comments box below and he will do his best to answer them for you. Okay, so guys, today we have Glen Russell from Russell Financial Solutions. He has been on the channel before. Last time we spoke about some sort of frequently asked questions with regards to property and mortgages. Today we're going to take a bit of a deeper dive. So Glen, thank you so much for visiting the channel again, mate.
Hi, Gary. No, you're very welcome. Thanks for having me back on.
So before we get started with the questions that I've got ready for you, do you mind giving a bit of a breakdown about you over the last, say, 6 months?
Yeah, sure, no problems. In a nutshell, my name is Glen. I'm a property investor and a qualified mortgage broker. My channel and stuff is really about learn by doing because it's my day-to-day job. So essentially, you know, we look after people's mortgages and insurance day to day, but I also sort of live that journey as well. So I'm an investor as well. In the last 6 to 8 months, I've bought 2 properties as buy-to-let investments, and we exchanged last Friday on the second one, and we picked the keys up on the 30th of this month. So yeah, everything that I do really in my life is about property and finance, and trying to document the story as best I can, really.
Brilliant. And congratulations on the latest purchase, mate. So yeah, for anyone that didn't see the last interview, is it solely property you're investing in right now, or do you dabble in anything else too?
I say, well, the word dabble, I don't put too much into it, but off the back of your videos, actually, Gary, I've put a few bits into trading 212 app, having a look at sort of cryptocurrency as well, but I've only briefly touched on it. But property is essentially what I really enjoy. I love it's a tangible asset I can touch, see, and physically do stuff to it, as in, renovate and stuff like that. It makes sense to do what you know. So moving on to my questions. The first question I've got jotted down is, in your opinion, as you work within property and sales every single day, what's the market like right now? So is it still booming like it was last year? Do you think prices, this is a multi-question question, by the way, do you think prices are fair right now, or do you think people are paying above and over value? Well, first question, the market is absolutely booming. There was no let up over Christmas. 2020 was crazy. Us as a business, when you think in a pandemic, you'd think we'd be really quiet. Sure. We haven't. It's made a massive difference for people living in their own homes. A lot of people are now working from home. They've realised they need more space. So a lot of people have done remortgaging to raise capital, to put extensions on their property. So that's a completely different side of the market, really. People don't need to move to still need mortgages and put value on their house. So that's one element. And then obviously the stamp duty change that the Chancellor done and then extended it again. Everyone then took the opportunity to save thousands of pounds in stamp duty. And then that's pushed the market the other way. So then everyone's moving, upsizing where they thought they didn't want to or couldn't afford to. So the market both ways has gone mad, which is great because it's what the country needs. The country needs people to move. That's how the money moves around as well. But also the second part of the question is, do you think people are buying? Is it over inflated? I would say we are in a bubble, and I do think there are some areas where people are possibly buying properties which are a little bit overinflated. However, if that person is buying with a mortgage, the mortgage lender, from their point of view, are also very strict. Yeah. So when they do a valuation on the property, they're not a surveyor is not going to do a valuation just because the market is booming. They will do a valuation on what they feel that property realistically is worth, and they take many factors into account. So I think in a good way, the mortgage lenders and the surveyors are keeping that level a little bit lower. It always comes back down to, which I say is, if you want to move and you can afford to move, and it's the purchase price which is affordable for you, then move. Because if you wait with the property market to see if it drops or if it goes up, you could be waiting 5-10 years. It fluctuates all the time, like the stock market. And the thing is, it only really makes a difference when you buy or when you sell.
Of course. You covered so many different points in that. And the final point you made is, I suppose we do need to think with our head as well as our heart. So the next question I've made note of, you've already started mentioning in the previous answer. So I actually saw an update about the stamp duty holiday and the 5% mortgages actually on your channel. So how do you see these extensions? Do you see there being any problems with these? This may be my limited knowledge on this side of things, but my understanding was our crash back in 2008 was partly caused by sort of overlending and sort of low deposits. Is that right? Or am I completely wrong? What are your thoughts on this?
Yeah, I mean, loads of factors you covered off there. So, I mean, to start with 95% mortgages, I think it's only a positive because the industry needed that product. First-time buyers needed that product.
Yeah.
And as we just touched on, property prices are increasing quicker than people can save. We're an island, we're running out of room, we're not building enough houses, which means there's a greater demand and there's more people wanting to buy, which is a good thing, but they need help to be able to do it. So the lenders, it's more and more every day, are bringing out 95% mortgages, which is good. Understandably, the rates are slightly higher for the client because it's bigger risk. The point that you touched on in 2008, when the market crashed, there was a lot of people in negative equity. And long story short, I was one of them people. In 2008, before I was a mortgage broker, I worked in a bank. I bought my first flat and for £180,000 in 2008. And literally the market crashed about 2 months after I purchased it. And I got an estate agent to come around and they valued it at 165,000. So it dropped all that in 2 months. So I felt naturally quite sick.
Of course.
But again, it was one of them things that I thought, long game. Basically, 3 years ago, I sold the property and sold it for 225,000.
Amazing.
Within that time, I'd actually rented out the property, so a tenant had been paying the mortgage. So because I actually reviewed that it being an asset rather than an issue from the crash, it's actually worked out well. So this goes back to buying and selling at the right time, really. But the differences in 2008 to now is that the banks and building societies were lending 125% mortgages. So people were instantly in debt. They were also doing 100% mortgages. So the market didn't need to really do much for someone to straight away be in negative equity. And lenders now, there's so many more things and hurdles that you need to jump to get a 95% mortgage. So they do really review the risk to the customer for, like, you know, mostly to the customer and to them. And then they basically will give that decision off of the back of that. So I think in response to your question, there's a lot less risk now for the customer and the bank, whereas in 2008, it just obviously rocked the world.
Yeah, you sum it up perfectly. Obviously, now the banks have been stung before. They're very unlikely to get stung again, aren't they?
Just to add on that as well, sorry, Gary, that is a really key point because the banks in 2008 didn't have enough money basically as backup, and the regulators made that one of the key things moving forward. The banks had to have a certain amount of emergency money in case they ever needed to be bailed out, because the government bailed a lot of the banks out. So now they've got their own pot of savings, so to speak, to be able to bail themselves out if anything went wrong. Yeah. And banks have actually saved them. I think it's the last article I read, which was probably about 6 months ago. I think they have 6 or 7 times the minimum amount required now in surplus money. So they need to lend it because that money's sitting there and they're not making any money on it. Yeah. So that's why the mortgage lenders do want to lend.
So talking about sort of the struggles of getting onto the property market, something a few of my viewers have brought up in the past is about shared ownership. So I was wondering if you have much experience about shared ownership. Maybe you could give a brief summary what it is and how it works.
Yeah, sure. So shared ownership again is a really good option if people do want to get on the ladder. Um, it's obviously quite limited because you have to buy a property which is part of the shared ownership scheme.
So,
But
to interrupt, who owns the other share? To make it really for us simple people, who owns the other share of the property?
yeah, so it can be various different companies, really. It could be either a local council that own the development. It could be a property development company that have signed up to the shared ownership, or a percentage of the houses that they've built are part of shared ownership. So you find that with a lot of big new build estates now. You can look on the website, the shared ownership website, and even on some of the internet search websites, which you look for properties. They have options and tabs that you can click shared ownership. So you can really filter it down as well to find it. But essentially what it is that you would buy a percentage of that property, and the remainder will be owned by the development company or the local council. You would pay a mortgage amount on the part that you own, and you would pay rent on the part that the other company own.
Mm-hmm.
The good thing is about that is that over time you do have the option, because they want to sell the whole property to you, but obviously that might not be financially viable for you at this stage. So they do something called step laddering. What that means is sort of like every year or every 2 years, you can contact the company, and you may have a little bit more money, your earnings may have gone up, and you feel, well, actually, we want to buy a bigger chunk of the house. So, for instance, if you own 25% of it, you may want to buy 50% of it. Then you would speak to your mortgage broker or the mortgage lender, speak to them, make sure they're happy for that with the lending. And then it's just down to the legal side, and they change it. So on the deeds, you own a greater share, and the new build company or the local council own less of a share. And the end goal is to really own the whole property outright and be in the property within that time, enjoying living there as well.
Of course. So am I correct in believing that there is a rent cap on how much I don't know if you know, but I'm sure I read or I heard that there is a limit how much they can charge on the rent side of things. So the good thing is they can't just be doing it purely for profit.
Yeah, I mean, it's one of them tough ones because it's something you really need to do your own research on.
Of course.
And definitely go on the website for more specifics. But yeah, you are correct. Yeah, there is a cap. Because otherwise you would unfortunately get developers out there that would take advantage of people. Sure. They may be paying a really reasonable mortgage and then a horrendous rent, which isn't advantageous to them.
As a broker, is there any big problems with finding mortgages for shared ownership?
It's a little bit more stricter with lenders because there's other factors involved. Sure. It's not just straightforward X and Y owns Z. Mm-hmm. There's other factors to take into account, the legal side as well. But to be fair, they've been around for quite a while now. So lenders have got their heads around it, mortgage brokers have got their heads around it, and there's a lot on the market. So it would just be a matter of contacting a mortgage broker who does shared ownership, who has access to them products.
So a quick plug for you, anyone watching this, if you need shared ownership mortgage, don't forget your Russell Financial Solutions. Give them a Google search. So the next question my users have asked me is then going down the step of commercial property. So I was wondering if you have any knowledge on this, if you have any is there any pros and cons of investing in commercial property rather than residential property? I'd love to hear your thoughts.
Yeah, so commercial property are really good. They're great for investors. The positives with commercial is that you can rent them to a business. Mm-hmm. A business has a lot more, in most cases, has a lot more disposable income or available cash flow to pay rent, because the business is set up initially to know that they need a premises to pay for, to trade. So if you can buy a commercial property, even if it's something like a hairdresser's or a butcher's, anything like that, where there's going to be sort of consistent trade, that could be really good because you can get really good rent. The business is probably going to look to stay there for quite a long period of time. And it's really, a great investment long term. The yields are better than if you was to buy sort of residential. Return on investment generally is really good if you buy the right property to the right and rent it to the right business. However, they are harder to obtain from a mortgage point of view because, again, there is a lot of element of risk. Because if that business folds, who's going to pay the rent? So a lender will look at that. You can't just move a family into a shop to live in. So, you need another business. And this has been prime example in this pandemic. There's been a lot of businesses that have really struggled, which is really sad. And it's had a knock-on effect. So to all different factors that you don't generally see. But one thing just to be aware of is that there's elements of risk from a lender. If you're looking to buy a commercial unit to rent out, just be mindful of things like restaurants, anything that has facilities of cooking or anything of risk of fire. That is a factor that they will look at. And there are a lot of lenders that will lend. So that's, it's not that you can't do it, but just be mindful of they do everything on a risk-based assessment. And it's a lot less risky to give a mortgage to a client who, again, is going to be renting it out to hairdressers rather than someone who is, cooking day in, day out.
Sure. So just a quick sort of side question to that, and more sort of commercial type units that I hear. I suppose it wouldn't be classed as commercial, but other units I hear people buying for investments are things like sort of storage units and garage units. Can you borrow from lenders for property like this, or is that not possible?
It's very hard to, I'll be honest. Yeah, I mean, the thing is, if you're going to look at any sort of, I can't give advice on it because it's quite hard. It depends on the unit, it depends on the customer's circumstances. But anything like that with units, you're probably best to fund it with cash if you have it, because it's less risk to you. And also even sort of other avenues, even if there's other investors that, want to go 50-50 with you.
Great. Next up, so since I've quite often mentioned through various videos on my channel about the advantages of using a mortgage broker like yourself, and quite often the sort of feedback and the question I get back is, well, why do we use a broker when there's so many comparison websites? They do throw out deals that look quite good, but I'd love you to sort of give your sales spiel now and explain why you think a broker adds value to this website can do in 5 minutes. I'd love to hear your thoughts.
Yeah, it's horses for courses. Sometimes if it's a really straightforward, say a remortgage or a really straightforward purchase, you know what you're doing. There's no other elements involved. Then sometimes online is good. Mm-hmm. So I definitely wouldn't say don't use online because it does have its advantages. The only thing is with online is that people need to be aware of that these comparison websites, they promote the mortgage lenders that pay to be on them websites. So they're not promoting them because they're necessarily the best. They're promoting them is because they pay money to be at the top. So we have this conversation probably daily with clients where they tell us a product that they've found online, and we will research it for them and also give a comparable, because we can look at a whole comprehensive range of lenders and sometimes get preferential rates and cashback deals as well. Which they can't access directly themselves. It's one of them things that it's worth speaking to a mortgage broker, even if it's the initial chat, because they can tell you, and this is how we do business, if someone's found a product that is right for them and they've done it themselves, then we would say you can do it yourself. Mm-hmm. But it's not as easy as that, as what a lot of people do think. Also, you haven't got that element of picking up the phone if there's a question, or you've got an issue with some paperwork or the conveyancing or the solicitor side. We find that a lot of our customers contact us not about really so much the mortgage product, it's all the bits in addition to doing it, and that can be quite stressful if you don't do it day in, day out. The other thing is as well is that there are a lot of lenders out there that don't go on comparison websites that have fantastic products, really, really good rate. And the thing is, a mortgage is your biggest direct debit generally that you're ever going to have in your life, going through your bank account. So you need to get it right, because even if you do something like a 2-year fixed rate or a tracker or a 5-year fixed rate, you're committed to that rate, and it's a lot of money that you're paying every month. So even if your own peace of mind, whether it's us or another mortgage broker company, definitely speak to them and get a bit of guidance first before you make any decision. And then if the online rate is good and you're happy with it and the broker supports that, then great, go for it if that's how you feel.
No, that's a really, really open and honest answer. So just digging a bit deeper into your answer on that. Firstly, you said about sometimes you have clients coming into you with deals that they found online. Would you say that quite often when you sort of take a deeper look into the deals they found, maybe they aren't quite what they look like on the outside, so to speak?
Yeah, absolutely. Spot on. There are some comparison websites and some, that are linked to lenders. They'll have a mortgage affordability calculator on there. And we find a lot of the time that people think that they can afford what they need or maybe can't afford what they want because they've done the figures on a calculator that may be out of date, that might not factor in loads of different things like credit or debts. And I think also sometimes people don't always put in the correct information into a mortgage calculator because it's quick and easy to do. They generally just punch through some figures and then it's a little bit of guesswork. So with regards to a mortgage broker, you would go into it in more detail. You need to know specific numbers. You can't guess anything because at the end of the day, you could do all of the work right up to the point of mortgage application, which could credit score the client. And then the underwriter will say no. And that could have been eliminated right at the start from speaking to someone that knows what they're doing. Again, on my previous point, it's such a huge risk. You need to get it right. Speak to the right people that do it day in, day out. That's all I can say, really.
No, that makes perfect sense. And then the final thing with regards to this question before we move on, just to clear up to viewers first, I've always used a mortgage broker personally. Unfortunately, it wasn't Glen because I didn't know Glen then. But I do sometimes look on comparison websites just to see latest deals and stuff. And I actually had this chat with Glen recently. I noticed that the way the comparison websites work, I felt like they very much pushed me towards the lowest interest rate. But my understanding is that's not necessarily the best option, because there was the option on some of the comparison websites to view by initial term cost. So that's the overall cost over the initial term, which to me made surely the most sense. You want to know what you're paying in total when you take into consideration fees and everything else. I suppose I don't know where I'm quite going with this question, but could you go a bit deeper on that? Do you think is this back to you thinking they're trying to push particular products? Do you think it's because people think that the best thing is a lowest interest rate where really there's so much more to it? What's your thoughts?
Potentially, I think the main thing is that you're technically sort of talking to a computer, which just has data in front of it and it will push what it's told to push. Whereas, the way that we factor it in is that we always go for the most cost-effective deal, excluding the early repayment charges as well. So because sometimes they factor in an early repayment charge on the mortgage, which can be thousands, and they're predicting you're going to come out of that. So they factor that as a cost. Well, you may not ever come out of that mortgage before the rate finishes. So you're technically getting the wrong advice from that computer. So it might be a carrot rate, as they call it in the industry. They dangle a carrot in front of you, so you think, that's a really good rate, I'm going to go with it. But when you factor in, it might have like a 1499 or a 999 product fee on top. It might not actually be the most cost-effective deal. So sometimes a slightly higher rate with maybe no fees across that term is actually better, and it will save you money over that term rather than just going for the lower rate.
Yeah, definitely. Okay, so finally, the very last question I've got for you. I know you guys at RFS obviously do mortgage brokering, but you also do brokering for various protections too, right? This is something I've done. I have to admit, it was something that didn't cross my sort of radar until recently. As a sort of what I would see a quite healthy 31-year-old man, I didn't really think about it until recently. So could you give a quick sort of breakdown on some of the different protections now available and who you think should really be considering this, or should we all be considering this?
Absolutely. I mean, it's one of the most important things really that you should look at because at the end of the day, there's only one you. And if you disappear, who's going to replace you and who is going to replace your income potentially? So especially if you're taking out a mortgage, it's a large debt generally. So, and if you're doing a joint application, you know, and there's two of you, can one person afford to pay that mortgage if the other person was to die? Now, none of us have a crystal ball and we know how long we're going to live. So it's one of them things that you should always look at least having life cover, because it gives you that peace of mind. And life cover, essentially what that is that if you die, a lump sum that you've agreed with the provider will be paid out to your spouse or next of kin or whoever you've put in the will. And that can potentially clear the mortgage that you have outstanding. So again, you need to take advice on it. The other side is, you know, critical illness. It's very, very sad to think that now the statistics are 1 in 2 of us will be diagnosed with a critical illness within our lifetime. Now that is slightly terrifying, because I remember when I worked years ago in the bank, it was 1 in 8 of us. So in just that period of time, you know, that has massively become very, very real for a lot of people.
Yeah.
Now, on the positive side of that, though, is one of the reasons why it's now 1 in 2 is because there is so much research that's now put into it. So cancers and different sort of critical illnesses have been diagnosed earlier, which is great because it's given people the chance of survival. However, really, if you have a critical illness, you really don't want to be worrying about paying bills. You just want to be focusing on getting better. There are policies in place where you can have a lump sum payout to you to be able to, you know, help you support or pay your mortgage off, or help you with bills, or generally have some money to go and do the things you want to do that you've always put off. Maybe you want to go on that certain holiday, etc., etc. So there's loads of different factors, and it's really, really good because you touched on the point of being a healthy 31-year-old, but with life cover, again, the providers look at it a risk because it's inevitable. We are all going to die at some point, which is very negative, but it is a realistic fact. Now, the older you are, the greater chance that that's going to happen. So the way that the providers see it is, who obviously set up the insurance for you. You can do it direct, but get it right first time. Or again, speak to us or a mortgage broker, whoever you feel comfortable with. But the younger you do it, the cheaper the monthly premiums. Now, we've done policies where people are covered for as little as £5 a month because they've done it when they're 18 years old and they're healthy and they've got healthy lifestyles. The flip side of it, we've done policies where people are paying hundreds of pounds a month because they're older, they've left it too late in the day to get a policy, and they may have had a family member that's had an issue and it's triggered them to go and get something. Sure. Whereas the point I'm really trying to make is that if you look at it early and you set up a policy early, if you get the right policy and you can get them where the premiums don't go up and down, you can get them guaranteed premiums for the lifetime of potentially like your mortgage, let's say 30 or 35 years, you could pay that, say £15 a month, and that will never change for the whole term of that mortgage. So it doesn't matter whether you have a less healthier lifestyle or if you have various different factors that affect you through life, which is going to happen. That insurance provider will honour the payout that you took out at the time of when you signed up for it. So again, it's never too early to get insurance in place, because the earlier you do it, the cheaper it's going to be. And also it gives you that bit of peace of mind. So, I mean, that's the life and critical illness. And the other side is income protection again. So if you're working and you was to break your arm, depending on what industry you do, or you just wasn't able to work for whatever reason, there is an insurance called income protection, and that can replace your monthly income that you would get from your job, or even a percentage of it. And again, that can be really, really cheap, dependent on your income, the amount of cover that you need or want, and when you do it, and the job that you do. So again, there's loads of options out there for you to have that peace of mind, knowing that if you can't work, your bills are still paid. If anything has happened to you, your family are covered. I don't think you can really put a price on that sort of peace of mind, because we work so hard now to save money, to get property, to pay our mortgage. And something can happen in your life within a split second that could change everything. And if you don't factor them things in, then it could cause real problems down the line for your family or even you.
Mm-hmm. So, as always, I've got multiple follow-up questions. So I'm sorry, mate.
That's okay.
The first one is, so the three main covers you've spoken about, so life insurance, critical illness, and
Critical
income
illness,
protection.
yeah.
Is there any certain people that you would like to talk down the camera to now that you think must be thinking about this right now, or would you say everyone should?
I think, my personal opinion, everyone should, because every single person generally has a need.
Yeah.
Even if you're a single person in a flat and you've got a mortgage, but you don't have a partner and you don't have children, and it's only yourself that you're looking after, then income protection could be something that you would look at, because you're so solely dependent on yourself.
Mm-hmm.
Then what would happen if you suddenly couldn't work? Who's going to pay your mortgage? There's all them different factors. You don't really want to be eating into savings if you have it. But on the other side, and we deal with a lot of customers in all walks of life. But if you have a mortgage in general, you should really look at life cover as a minimum. If you have children, you should look at life cover and potentially critical illness cover. And there's some really great providers out there now where they actually include critical illness for your children as well as part of the policy for no extra cost. Wow. And for me, myself, having children, that gives me real peace of mind, because if anything was to happen, I know that I can make a phone call and I've got immediate support there and the funds to be able to do whatever's needed to be done. So in answer to your question, don't put a price on insurance. Obviously, make sure it's affordable for you, but also make sure you get the right insurance, because I've spoken to so many of my customers and they think that they have insurance that covers them for what they need. And then when they dig a little bit deeper, they realize that insurance isn't even applicable anymore, because they may have changed jobs. They may have gone from employed to self-employed, which means that policy doesn't cover them anymore. Sure. Because it's set up differently. So they're paying a premium every month that won't actually pay out. They think they've got life cover and it's actually for an amount that's less than what they actually need because they've moved or remortgaged in that time. So just because you've done it once, don't think that that's it, it's done. And again, a good mortgage broker or any good company will review that for you every time you touch base with them, to make sure your circumstances have not changed and to make sure that policy is right for you. Last thing on that point is, I always say to people, don't look at life insurance as a cost that you just see going out every month. Look at it as part of your mortgage. You don't really have a choice to not pay your mortgage because you need it and it has to come out of your bank account every month. Look at your life cover or your insurances as an addition to that mortgage payment. Mm-hmm. And if you get in that mindset, then you won't resent that money, because it's not something you can tangibly see, but it's there as a safety net.
Makes sense. So the thing that it made me think of is we insure pretty much everything in our life now, even down to maybe our mobile phone. It seems crazy that someone wouldn't consider insuring their income or their life even, So I've certainly been swayed over to it. I have to admit, before it hadn't crossed my radar, and that was more naivety more than anything. The final sort of follow-up question I wanted to ask with regards to your answer with this is to do with when I did my income protection, being self-employed. And when I did it all through a broker, I read through the paperwork sent, and obviously there was he got a commission fee from the provider.
Yeah.
It come to my mind even, and this is someone that I'd been recommended to. But how do we know that they're not just pushing us towards whatever provider offers the best commission for him?
Honest answer, you don't. It's a matter of it. Again, it comes down to that relationship that you've got with that mortgage broker. I mean, if you've got them sort of doubts, then it's got to be an element of, are they the right broker for you?
Sure.
If it's just that you're inquisitive, I'd ask the question. I think any mortgage broker that is doing the right job for their client will be open and honest. As a mandatory requirement, because mortgage brokers are FCA regulated, we need to make the customer aware that we get paid commission as well. As you said, it's all on the breakdown of the illustrations before you even sign up. So anything like that, it's really important to be transparent and clear with the customer, because we live and breathe that. And I think that's why we have so many returning customers and new customers anyway. It's important to have a relationship with that mortgage broker, or that company at least, because it's a really, really good question. And I'm sure that it runs through a lot of people's minds when they see the commission paid at the bottom. But essentially, you've got to look at it that, is it the right monthly premium? Are you happy to pay it? And does it cover you for what you need? And I think when you drill it down to them factors, if that is right, then that's the priority for you as a customer. But one of the other things I just wanted to quickly touch on, which is really important with regards to life cover. We get a response from a lot of people saying, it's okay, I'm covered with work, and for a lot of employed people. So that's fine. But what people don't factor in is that, do you think you're going to be working there for the next 35 years?
Sure.
If that's the term of their mortgage, potentially. No one can answer that question. So it's really great that they may have, say, life cover or some sort of protection with their employment benefits, which is great, but you should always have something in addition to that. Because if you suddenly get made redundant, or it just doesn't work out where you're working and you need to go somewhere else, there may be that employer doesn't offer that benefit. And you've left yourself open, really, to having no cover. And that's what you really don't want, something to happen to you when you most need it. So anyone that is watching this that thinks, it's okay, I've got life cover or I've got protection with my employer, great, that's a real positive. But also look at getting, even if it's a small policy, to run alongside it, because if you leave that job, you have still got something in place.
Makes perfect sense. So unfortunately, that is my questions over. As always, I could sit and chat to you for hours. I really could. So I'm sorry for keep throwing questions at you for what you thought was probably going to be a nice, quick interview. So as Glen's mentioned in today's video, he can't really give sort of dedicated advice. However, if you do have any questions for him, please leave them in the comments box below. He said he's going to watch out for the comments and he will try and answer if he can and if he's allowed to. If you have something a bit more in depth, I'm sure Glen won't mind whatsoever you ringing him in the office and maybe becoming an RFS customer. So they are Russell Financial Solutions. If you give them a Google, I'm sure you'll find them instantly. Apart from that, Glen, I just wanted to say thank you so much. I'll be linking your channel down in the description. Make sure you leave a comment. I'll pin it. And apart from that, we'll speak to you very soon, mate.
Great stuff. Thanks, Gary. Been a pleasure. Take care.